A lot of people think dividend investing is slow, boring, or only for retirees. But the truth is, it can start with something as small as $20 a week and grow into serious life-changing income. Over the past couple of months, I've made a bunch of videos breaking it all down, from beginner strategies to deep dives into specific funds and real-world examples. So in this compilation, I've put together the most helpful videos, the ones that show exactly how to start building passive income step by step. You will learn why Warren Buffett loves dividend stocks, how much income you really get from $1 million portfolio, and whether DGRO or SCHD is the better ETF right now. You'll also see how to avoid common mistakes with Roth IRAs and 401ks, and how to build a simple setup that can change quarterly dividend payouts into a weekly $300 to $400 dividend income payout. Plus the $20 a week plan that could turn into $7,000 a month. If you've ever wondered what actually works, not just what sounds good online, this compilation lays it all out. So grab a coffee, get comfortable, and let's get into it. Everyone knows Warren Buffett is rich, but most people have no idea how he actually gets paid. Spoiler, it's not stock trading. It's a slow, almost boring system built around dividend stocks that generates billions even when the market is crashing. In this video, I'm going to break down how he does it, the iconic dividend stocks that built his empire, and in the end, I'll show you Buffett's most recent buys, which might just become the next Coca-Cola, that currently pay him over $2 million in dividends every day. Now, before we break it all down into complex strategies or big financial words, let's ask the real questions. How does he do it? Why is he so obsessed with dividend stocks? And most importantly, what can you learn from it? Buffett, often called the Oracle of Omaha, doesn't chase flashy trends or the next big thing. He believes in owning solid, profitable companies that return cash to shareholders year after year. His secret technique? Buying businesses that generate reliable profits and then holding on to them forever. And these businesses send him a check in the form of dividends every few months just for owning the stock. Dividends are a company's way of saying, thanks for trusting us, here is your share of the success. For Buffett, those steady payouts are more than just a reward, they're a tool. While most investors focus on price charts and market timing, Buffett focuses on cash flow. And dividends are the most reliable cash flow you can get in the market. Take Coca-Cola, one of Buffett's legendary holdings. He started buying shares back in the late 1980s, and he's never sold. Why? Because every year, Coca-Cola pays Berkshire Hathaway hundreds of millions in dividends. In fact, he's set to receive approximately $816 million in dividends from Coca-Cola in 2025. This substantial income stems from Berkshire's ownership of 400 million Coca-Cola shares, each yielding an annual dividend of $2.04. This equates to around $204 million quarterly, or roughly $2.23 million daily. And those checks keep growing. That's income without lifting a finger. Multiply that by dozens of similar positions, and you start to understand the scale of his strategy. Even better, Buffett uses those dividend payments to buy even more dividend-paying companies. It's a self-feeding machine. Money comes in, and instead of just sitting on it, he reinvests it. This cycle repeats and compounds, and many of these companies are so strong they increase their dividend payouts over time. So Buffett isn't just earning passive income, he's earning growing passive income. So if you're wondering why the world's greatest investor prefers slow and steady over fast and flashy, the answer lies in the quiet, powerful world of dividend stocks. Let's take a look at the core strategy Buffett follows and how it turns steady income into legendary wealth. Warren Buffett once said, "Our favorite holding period is forever," and that's the backbone of his investing mindset. He's long warned against chasing quick wins or bailing out of good companies too early. In one of his iconic letters, he even said, "It's like cutting the flowers and watering the weeds." In other words, don't sell winners and keep losers, do the opposite. Buffett's strategy is almost shockingly simple. Find great businesses, buy them at reasonable prices, hold them for decades, and collect the cash they generate.
To buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
But he doesn't need to sell to make money. He lets dividends do the work. Over time, those dividend payments add up, and when they're reinvested wisely, the snowball just gets bigger. That's compounding in motion. All right, let's bring this all to life in the clearest, most relatable way. Let's say you invest $1,000 in a stock that pays a 4% annual dividend. That first year, you'll earn $40 in dividends. Now, instead of spending it, you reinvest it, buying more shares of the same stock. So now, you're not just earning dividends on your original $1,000, you're earning dividends on $1,040. Fast forward to year 2, your new dividend check is $41.60. You reinvest that too. And now your total investment grows to $1,081.60. By year 3, your investment is worth $1,124.86, and it's growing faster each time with more dividends. That's the power of compounding. Your money earns money, and then that money earns even more. It might seem small at first, but that snowball effect picks up speed. And when you stretch that out over a decade or 3, you start to see why Buffett doesn't need to sell to make money. He just lets the dividends do their thing, and the math takes care of the rest. So why does this pair so well with dividends? Dividends let you benefit from a company's success without selling your shares. Think of it like owning a rental property that pays you every month, but you never have to move out. You still own the property, it still grows in value, and you keep getting paid. Let's take See's Candies, for example. Buffett bought the company in 1972 for $25 million. It didn't become a tech giant or a global powerhouse, but it consistently made money. And because it had few opportunities to grow fast, Buffett took the cash it earned, millions in dividends, and poured that money into other high-return investments. It's a playbook he's followed again and again. To put that into perspective, if John had bought its shares in 1972 and held for the next 35 years while reinvesting the company's copious dividends back into the stock market, he would have turned a $10,000 initial investment into more than $387,000 after adjusting for the effect of inflation. That means $1.9 million in nominal terms. Buffett calls businesses like See's cash cows because they churn out money without needing a lot of maintenance. He loves companies that don't just grow, they generate. And that generation becomes fuel for more investments. It's an upstanding cycle. This method has helped Buffett ride out market crashes, bubbles, and booms with almost eerie calm. While others panic or sell, he collects checks and just waits. And while he rarely talks about excitement, his quiet confidence comes from knowing his investments are working for him even when he sleeps. But how did this play out in the real world? Which dividend stocks turned this strategy into real results? Stick around, because up until now, we saw Coca-Cola paying $2.3 million every day. Well, in the end, I'll show you Buffett's most recent buys, which might just become the next Coca-Cola. Okay, now let's get into the part where Buffett's strategy really shows results. Over the decades, Warren Buffett has turned those investments into dividend machines. Some of the most iconic businesses in his portfolio have paid Berkshire Hathaway billions over the years just for owning the stock, and that's no exaggeration. Let's start with Coca-Cola. Buffett began buying shares in 1988, and he didn't just nibble, he went big. Today, Berkshire owns over 400 million shares of Coke. That's a stake worth billions. Now, Coca-Cola pays Berkshire over $800 million every year in dividends. Back then, the dividend yield on his cost basis was decent, but now it's astronomical because he bought early during a dip in Coca-Cola share prices, and he held on. His yield on cost is now over 50%. This means Buffett is making half of his investment every single year without selling. Next up is American Express. Buffett began investing in Amex during a crisis in the 1960s when the stock was under pressure. Since then, it's grown into one of his largest holdings. Today, Berkshire pulls in hundreds of millions of dollars annually from American Express dividends. And just like with Coca-Cola, those checks keep getting bigger. That's the beauty of long-term investing. You don't just get paid, you get paid more over time. Then there's Procter & Gamble, another consumer giant Buffett invested in heavily through his Gillette acquisition. Though Berkshire eventually exited most of the P&G position, the years he held it provided plenty of steady, growing dividends. These companies all had one thing in common. They sold things people buy, no matter what, like toothpaste, soda, credit cards. Buffett doesn't invest in trends, he invests in habits. The real genius here is the discipline. Buffett didn't jump ship when things were slow. He didn't chase the next hot stock. He planted his capital in well-run companies, let them grow, and let them pay him back. That consistency turned into compound growth. And while it's easy to focus on the headline numbers, the hidden engine here is reinvestment. Every dividend that rolled into Berkshire became capital to buy more stock, and many of those purchases were just more of the same companies. Coca-Cola paying for more Coca-Cola, Amex dividends fueling more Amex shares. It's the investment version of recycling, and it made the snowball roll faster. What's even more impressive is the reliability of these companies. Through financial crises, recessions, and pandemics, Coca-Cola and Amex kept sending checks. That kind of dependability is rare in today's market, and it's a big reason why Buffett has stuck with these names for decades. When people talk about Buffett's investing genius, this is what they mean. It's not about picking winners. It's about building systems that generate cash like clockwork. These were the foundations, the plays that proved the system works. But Buffett isn't just living in the past. The next logical question is, what has he been buying in the last decade? And do those picks live up to the legacy of these dividend giants? So what has Warren Buffett been doing with dividend stocks in the past 8 years? Has he changed his approach? Not really. If anything, he's doubled down, but with a modern twist. The names might be different, but the strategy remains the same. Find companies that throw off reliable cash and hold on for the long ride. Let's start with the biggest and most obvious example, Apple. Buffett began buying Apple stock in 2016. At first, people were shocked. Why would the king of value investing go all in on a tech company? But Buffett didn't see Apple as a typical tech play. He saw it as a consumer brand with an ecosystem so sticky it resembled Coca-Cola, but in the digital age. And while Apple isn't known as a dividend monster, it does pay. And for Buffett, that steady income plus capital appreciation is the perfect combo. Apple's current dividend yield may be modest, around 0.5%, but the scale makes it powerful. Berkshire owns over 300 million shares, and that translates to around $300 million in dividends. Plus, Apple keeps raising its dividends slowly over time, and that's on top of the share buybacks, which increase Buffett's ownership percentage without him lifting a finger. Then there's Bank of America, another giant dividend play in Buffett's portfolio. Bank of America pays a dividend of roughly 2.44%, which translates to more than $797 million for Berkshire. But why does Buffett like it? Because it's a stable bank with consistent earnings and room to grow its payouts. Chevron and Occidental Petroleum are newer but increasingly important parts of the dividend picture for Berkshire. After Buffett shifted more attention to energy in recent years, these oil giants have delivered both capital gains and fat dividends. Chevron's dividend yield is around 4.77%, Meanwhile, Occidental has a dividend yield half of Chevron's, but it has strong growth potential. Berkshire has collected hundreds of millions in cash from these two alone, and with oil prices remaining high, that flow isn't slowing down anytime soon. Let's not forget Kraft Heinz, a stock that's had its share of ups and downs. Berkshire owns nearly 27% of the company. And while the share price has struggled, the dividends have not. The annual yield hovers around 5.7%, and Buffett continues to collect substantial income from it. So how do these modern picks stack up against the old classics like Coca-Cola and Amex? In many ways, they're doing the same job. They provide a reliable cash flow that Buffett can deploy elsewhere. Apple might not yield as much as Coca-Cola, but the dividend income is massive simply because of the size of the holding. Chevron pays more per share than most of Buffett's legacy stocks, and energy dividends tend to rise with inflation, which adds another layer of value. One underrated aspect of Buffett's recent buys is diversification across sectors that still deliver dividends. From tech to energy to banking, he's built a new layer of income streams. These companies can weather storms and still pay investors along the way. And remember, Buffett doesn't just want dividends for the cash. He wants the optionality. Having $1 billion a year coming in means Berkshire can jump on big opportunities fast. It's financial flexibility, and it's part of what's kept Buffett ahead of the game for so long. But what's even more fascinating is that some of these stocks, like Apple, don't even pay high dividends, and yet they're centerpieces of Buffett's empire. That's because to him, dividends are part of the picture, not the entire canvas. Apple might only yield around 0.5%, but its massive reinvestment into innovation and consistent buybacks make it a powerhouse of value creation. Still, when it comes to raw dividend power, it's hard to ignore the billions Berkshire now collects each year. Add it all up, Apple, Bank of America, Chevron, Occidental, Kraft Heinz, and others, and you're looking at over $4 billion annually in passive income. That's more than some Fortune 500 companies make in total revenue, and Buffett gets it all without selling a single share. And while these numbers are impressive, they're not just trophies on a shelf. Buffett uses this income to take action. He's not hoarding cash for the sake of it, he's using dividends as fuel. Every dollar that flows in from Apple or Bank of America could fund a new investment, a private company acquisition, or support buybacks for Berkshire's own stock. That's how the machine keeps moving. Buffett has always said he likes companies that reward shareholders, but the way he defines reward has matured. It's not just about dividend yield. It's about what a company does with its earnings. If a company like Apple reinvests 85% of its profits and turns that into new shares and products that make the company more valuable over time, Buffett is all in. If a company has nowhere to grow but keeps printing money like Coca-Cola or See's Candies, then a dividend makes sense. It's that clarity of thought that makes him different. Most investors chase either growth or income. Buffett chooses both, depending on the business. That flexibility has allowed Berkshire's dividend income to grow massively in recent years without sacrificing the long-term compounding machine he's always nurtured. And this brings us to the big question. Which of these recent picks has the potential to be Buffett's next big dividend success story? Which of them might become the Coca-Cola of the next decade? Okay, so it's time to look forward. What stocks has Buffett added in the last 5 years that have the potential to become Berkshire's next dividend powerhouses or even the next Coca-Cola? One of the more intriguing additions has been Citigroup. It's been bought and sold. Berkshire's position in Citi raised a few eyebrows, but the rationale is rooted in classic Buffett thinking. The bank has a huge footprint. And while it's had its stumbles, it remains a core part of the financial system. Citi's dividend yield is 3.14%, offering Buffett another deep pocket of recurring income. While it's unlikely to become a top-tier performer like Bank of America, its current income potential is solid. If Citi stabilizes its operations, that yield could become even more valuable. There's also been a quiet but consistent accumulation in companies like T-Mobile. While not traditionally viewed as a dividend play, T-Mobile's recent moves suggest a pivot toward shareholder returns. It recently initiated a dividend and has room to grow both earnings and payouts. This could be one of Buffett's more forward-looking bets, a company that evolves into a dividend star over time, much like Apple did. Buffett's thinking around dividends isn't one-size-fits-all. He has a rule of thumb, something he's mentioned for decades.
The first question is when you have capital, is it better to keep it or return it to shareholders? It's better to return it to shareholders when you cannot create more than $1 of value with that capital.
That line is simple but powerful. It means that dividends are great when a business has no better use for its cash. But if a company can reinvest its profits wisely and generate even more value, then skipping a dividend might be the smarter move. Take See's Candies. Buffett bought it back in 1972 for $25 million. It's not flashy, it doesn't innovate, but it makes steady money. Since it doesn't need much capital to grow, the cash gets funneled straight back to Berkshire in the form of dividends. It's like a vending machine that prints bills instead of snacks. Compare that to Apple. It does pay a dividend, but its real strength is reinvestment. Apple retains about 85% of its profits, pumping that cash into research, new products, and stock buybacks, and it's working. Buffett's stake in Apple keeps growing in value, not because of big dividend checks, but because Apple keeps making itself more valuable. This is why he hasn't blinked. Even after selling a small part of his stake, the remaining shares still represent one of his smartest plays. Another standout in Buffett's recent moves is Occidental Petroleum. Berkshire owns just over 25% of the company and continues to buy. The dividend yield is modest for now, but the long-term story is compelling. Occidental has been reducing debt, ramping up production, and showing signs of increasing shareholder returns. Buffett seems to believe the future dividend stream from this energy giant could rival his biggest past winners. And let's not forget about Chevron. Berkshire has invested tens of billions into the stock, and with a yield over 4.77%, Chevron stands as a rock-solid payer. It also increases its dividends regularly, giving Buffett that beautiful blend of steady cash and growing income over time. For a man who values predictability in an unpredictable world, Chevron is a textbook Buffett pick. No one actually knows which one will be the Coca-Cola of tomorrow. It's impossible to say for certain, but the candidates are clear. Warren Buffett bought Coca-Cola stock in 1988, investing around $1.3 billion. Today, that same investment pays him over $700 million every single year in dividends, meaning he's receiving over 50% of his initial investment back in dividends each year. Not from selling, not from timing the market, just from holding. You don't need billions to do this. You can get a comfortable retirement income if you have $200 a month to invest. In this video, I'll walk you and John through a simple 5-step roadmap to retire with dividend stocks. I'll show you how dividend reinvestment builds wealth and how to pick the right stocks to hold forever. In the end, I'll show you a 5-stock portfolio that with a $200 monthly investment, you can grow to a $2 million portfolio and pay over $10,000 in monthly dividend income by the time you retire. But first, let me explain why I chose passive income over capital gains. Most people think the only way to make money in the stock market is by buying low and selling high. That's the Hollywood version. Fast trades, wild swings, get rich quick. But in reality, it's exhausting. You have to constantly guess where the market's going, sell at the right moment, and hope you're not taxed into oblivion. It's like trying to win a game that you can't control. But what if instead of trying to time the market, you focused on getting paid consistently? That's the core of dividend investing. You buy shares in businesses that share their profits with you every quarter, every year, like clockwork. No guesswork, just income. Instead of stressing about when to sell, you're focused on which companies will keep paying and growing those dividends over time. That's what makes it so powerful. It flips the entire mindset from gambling on short-term gains to building reliable, long-term cash flow. The emotional payoff here is huge. With capital gains, your wealth is always on paper. Until you sell, it's not real. But with dividends, you get real money in your hands regularly. It's predictable, it's empowering, and it's incredibly motivating to watch those payments grow. And here's what's even better. That money doesn't stop just because the market dips. If companies are strong, they'll keep paying. That kind of resilience creates a sense of control most investors never get. It's the kind of strategy that lets you sleep at night and still build wealth while you're at it. So what makes this actually work? Let's be honest, most of us want financial freedom, but we're wired for quick wins. That's why so many investors chase fast gains and end up burnt out or disappointed. Dividend investing flips that script. It works not because it's flashy, but because it plays into two unstoppable forces: time and consistency. First, let's just talk about psychology. Humans are emotional about money. We panic when markets drop and get greedy when they rise. That leads to bad decisions, buying high, selling low, and jumping from one hot stock to the next. But dividends create a different mindset. When you know you're getting paid regularly, even during market downturns, you stop obsessing over price swings. Your focus shifts to income growth, not just portfolio value. In fact, this market fluctuation can work in your favor if you reinvest your dividends. This gives you two perks. One, you get the compounding effect going, which I'll explain in a bit. And two, you benefit from the dollar cost averaging strategy. Let's walk through a simple example over 3 years. You invest $1,000 into a stock priced at $20 that pays a 4% annual dividend. That gives you 50 shares and $40 in dividends after the first year. Now, instead of taking that cash, you reinvest it. The stock has dipped to $16, so your $40 now buys 2.5 more shares, more than you would have gotten at the original price. For reference, at the original price, you could have bought only 2 shares. That's dollar cost averaging in action. When prices are low, your dividends buy you more shares automatically. You're building your position at a discount without needing to time the market, and vice versa. In year 2, you now own 52.5 shares. At 4%, that earns you about $42 in dividends. The stock recovers slightly to $18 and you reinvest again, this time getting around 2.33 shares. Now you've got 54.83 shares of the stock. By year 3, those shares generate $43.86 in dividends. The stock is back at $20 and you reinvest to get 2.19 more shares, bringing your total to over 57 shares of the stock. You started with 50 and just by reinvesting the dividends, you've grown your holdings by more than 14% in 3 years without adding any extra money. That is how dollar cost averaging and compounding grow your wealth. Over time, this compounding becomes incredibly powerful. Even a small portfolio can balloon into something massive if you give it enough time and keep reinvesting every payout. Take UFP Industries, for example. Over the past 10 years, its average dividend growth has been over 20% annually. That means if they paid you $100 in dividends last year, this year it would be $120. Multiply that by dozens of companies and suddenly your cash flow starts snowballing. And unlike growth stocks, which you need to sell to make a profit, dividend stocks let you enjoy your gains without touching your principal. It's the difference between chopping down a tree for firewood and just picking up apples from it every season. Your investment stays intact, but it still provides regular value. Now, at the end of this video, I'm going to walk you through a real-life dividend portfolio, a combination of companies that, if built today, can turn a $200 monthly investment into a $2 million portfolio that pays over $10,000 in monthly dividend income. But first, how do we pick the right dividend stocks to hold forever? Well, it starts with knowing what kinds of companies deserve a permanent spot in your life. The goal isn't just to pick any stock that pays a dividend, it's to find businesses that can survive, grow, and keep sharing profits with you for decades. First, focus on dividend growth, not just yield. A high yield might look attractive up front, but it can be a trap. If a company is paying out too much of its profit, it might cut its dividend during tough times. Instead, look for companies that consistently increase their payouts every year. That's a sign they're healthy, profitable, and confident about the future. Let's take Visa, for example. The yield isn't huge, less than 1%, but over the years, it's raised its dividend more than 17% annually. Next, you want durability. Companies that have weathered multiple recessions, kept customers, and grown their business steadily. UFP Industries is a great example of this. It's been growing its dividend by over 20% per year, and its share price has climbed with it, thanks to smart management and solid fundamentals. So how do you balance growth and yield? Well, a good rule of thumb is to combine a few high-growth dividend stocks with some stable, moderate yield players. For example, Goldman Sachs doesn't have explosive growth, but it has a reliable yield of around 2% and a solid track record of performance. Blending that with a fast riser like UFP gives you both cash flow and future upside. Diversification matters too. You don't want to rely on just one industry. If you're dividend-focused, add a dividend-focused ETF like SCHD. It helps a ton. Based on these criteria, strong dividend growth, solid fundamentals, long-term appreciation, and diversification, I've selected these stocks for a retirement-focused portfolio. Each of these picks serves a specific role in the overall portfolio. SCHD, the Schwab U.S. Dividend Equity ETF, acts more or less as the foundation. It offers broad exposure to reliable dividend-paying companies and delivers a strong 3.93% yield, making it a steady, diversified core. Goldman Sachs brings consistency from the financial sector with a solid 2% yield and nearly 18% dividend growth, ideal for dependable income. Morgan Stanley plays the role of an aggressive dividend grower, offering a rare combination of a 2.8% yield and over 23% dividend growth, giving your income serious momentum. UFP Industries is the compounding engine. With a lower yield of 1.36% but over 20% in annual dividend growth, it's designed to snowball over time. And then there's Visa, a long-term appreciation play. Its yield may be small at 0.65%, but with consistent 17% plus dividend growth and strong fundamentals, it adds growth without sacrificing stability. Together, these picks balance yield, growth, and resilience, creating a portfolio built for long-term retirement-focused passive income. Now the final piece, reinvestment. If your goal is long-term wealth, reinvesting dividends is non-negotiable. It turns income into more income. More shares, more payouts, and more compounding. You're not just investing, you're creating a system that feeds itself and gets stronger each year. So when people ask, how can I start dividend investing and never sell? This is how. Choose companies with growing dividends, strong fundamentals, industry diversity, and a history of resilience. Set it up once, keep reinvesting, and let time do the heavy lifting. But hold up, before showing you how this portfolio can turn a $200 monthly investment into a $2 million portfolio, there is a reason why not everyone does this. So let's talk about the trade-offs. Dividend investing sounds almost too good to be true. Steady income, no need to sell, and long-term growth. But like anything worth doing, it does come with some trade-offs. And if you're going to commit to the never sell strategy, you need to know what you're giving up and what it takes to stay the course. First up, growth envy is real. When everyone around you is bragging about 50% gains on a tech stock they flipped in 3 months, your 2% dividend yield might feel pretty boring. Your portfolio probably won't double overnight. That's because dividend-paying companies are often more mature, stable businesses. They're not focused on explosive growth. They're focused on returning cash to shareholders. And that's a feature, not a bug. You're trading hype for reliability and building a strategy around consistency. Another challenge? Patience. This strategy isn't Hollywood. It's slow and boring at times, to be honest, but it works for Warren Buffett. It made him billions, so it is more than good enough. At first, the dividends might feel small. You might earn just a few bucks a month. It's easy to question whether it's worth it, but remember, those early dividends are seeds. Reinvest them, and they start growing into more shares, which give you more dividends, and on and on. It's not about how it starts, it's about where it goes. This is a snowball you build piece by piece, and before you know it, it becomes unstoppable. You're also giving up the flexibility of quick cash outs. Look, if you're used to trading in and out of stocks, the never sell approach to retirement requires a mindset shift. You're committing to companies for the long haul, through the ups and downs. And yes, there will be downs. Even great dividend stocks can drop in value during a market crash. But if the business is strong, the dividends usually keep coming. And that's the income you care about. And let's be real, this strategy requires discipline. You'll be tempted to chase higher yields, panic sell during corrections, or pivot to the latest trend. The key is sticking with your system. That means reviewing your companies once or twice a year, making sure they're still performing, and resisting the urge to constantly tinker. Think of it like tending a garden, not ripping it up every season. Listen, the truth is every strategy has drawbacks. The question is, which trade-offs are you willing to live with? For dividend investors, the peace of mind, stability, and growing income are worth more than flashy short-term wins. And if that sounds like your style, then let's dive into the real numbers. Here's how this strategy actually plays out for your retirement. So, you know the stocks I selected, and you know each of their forward dividend yields, dividend growth rates, and their share price appreciation. But if you want to invest in a portfolio, you need to find these figures for your overall portfolio too, and that's actually fairly simple to calculate. To calculate the overall portfolio metrics, I keep it simple. Since each stock in the portfolio is treated equally, I just took the average of their individual numbers. For example, to find the average forward dividend yield, I took the dividend yield of each stock, 3.93% for SCHD, 1.94% for Goldman Sachs, 2.8% for Morgan Stanley, 1.36% for UFP Industries, and 0.65% for Visa. Then I added them up and divided by 5. That gives us a total of 10.68% divided by 5, resulting in an average forward yield for the whole portfolio of 2.14%. Why 5, you ask? Well, because that's the number of stocks I have in my portfolio. I use this same method to calculate the average dividend growth and average share appreciation. It's a straightforward approach anyone can follow, and it gives you a clear snapshot of what to expect from your portfolio overall. So, using the calculation, my portfolio has a dividend yield of 2.14%, an average dividend growth rate of 18.12%, and an average share price appreciation of 13.64%. Based on these metrics, let's see what the future projections look like if John invests, let's say $200 a month into this portfolio. That's less than $7 a day, or for some, just the cost of a single cup of coffee. By the end of the first year, he would have invested around $2,400. This sets the stage for future growth. Fast forward 10 years and John's portfolio will be valued at $52,281. And if he keeps contributing and reinvesting dividends at the 20-year mark, things start to get exciting. His portfolio would be valued at $323,375. But the real magic happens over the long run. After 30 years, John's total investment of $72,000 from monthly contributions will have grown to a massive $2 million. $2,057,175 to be exact. His annual dividend income around that time would be approximately $129,240 or about $10,770 every month. Enough to comfortably retire without ever needing to sell a single share. Out of the total gains, about $1.36 million came from capital appreciation and another $628,000 from reinvested dividends. Most investors don't realize they're leaving hundreds of thousands or even millions of dollars on the table, and it's not because they're reckless, it's because they picked the wrong dividend ETF. In this video, I'm going to break down the differences between DGRO and SCHD. Which one grows your portfolio faster? I'll break down their performance, compare their strategies, and help you and John decide which ETF might be the better choice for your $100,000 investment. In the end, I'll walk you through a side-by-side projection that shows which ETF could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. But before we get into the numbers, let's clear up what these ETFs actually are. Because yeah, they're both dividend ETFs, but how they go about it couldn't be more different. Starting with DGRO, this is the iShares Core Dividend Growth ETF. It's been around since 2014 and comes from BlackRock, one of the biggest names in investing. It focuses on U.S. companies that not only pay dividends, but also have a consistent track record of increasing those dividends year after year. It tracks the Morningstar U.S. Dividend Growth Index, which applies specific filters to screen for financially stable businesses with sustainable payout ratios and solid earnings. DGRO holds over 400 stocks, giving you exposure to a wide swath of the U.S. economy across tech, finance, healthcare, energy, and more. It's designed to capture steady long-term growth from businesses that don't just return cash, they grow it. On to SCHD, or the Schwab U.S. Dividend Equity ETF. This ETF was introduced a few years earlier in 2011 and is managed by Charles Schwab Investment Management. Unlike DGRO, it targets companies offering higher dividend yields right now with good dividend growth, but it's very selective. SCHD tracks the Dow Jones U.S. Dividend 100 Index and screens for companies with strong financials using strict metrics like return on equity, dividend consistency, and cash flow. With just over 100 stocks, SCHD is more concentrated. But that also means it zeroes in on high-conviction, cash-rich companies that tend to be more mature and income-focused. So DGRO is broadly diversified and growth-oriented, while SCHD is more selective, yield-driven, and focused on financial quality. Both are strong, but they're built slightly differently. Now, let's see what those differences have meant when it comes to actual returns. Over the past 10 years, DGRO has returned 136.32%, showing steady and consistent price appreciation. In the last 5 years, it delivered 70.27%, and even over the past year, it was up 10.42%. That consistency makes it appealing for investors who value growth that doesn't come from wild swings. DGRO has handled both bull and bear markets with relative stability, offering a dependable track record for compounding returns. Now, it's not a monster dividend payer right out of the gate. Its current yield sits at around 2.2%. While not the highest, its advantage lies in the growth of those dividends. Over the last decade, its payouts have grown at a solid pace, giving long-term investors more income each year without needing to chase yield. It currently pays out about $1.39 per share annually, and that number tends to increase steadily. This makes DGRO a strong choice for those focused on building future income rather than collecting maximum dividends right now. Its expense ratio is a lean 0.08%, and the fund manages around $31.48 billion in assets. That combination of cost efficiency and scale adds to its reliability. The strategy behind DGRO, investing in companies that consistently raise their dividends, has clearly worked over time in terms of both price growth and dividend strength. Now shifting to SCHD, the numbers paint a different picture. Over the same 10-year period, SCHD delivered a total return of 103.64%. Over the last 5 years, it grew by 55.92%, and in the past year, it's up 3.97%. While these gains are still strong, they've trailed DGRO across each time frame. However, SCHD isn't trying to beat the market on growth alone. It's built for something else: income. Its dividend yield is 3.86%, a lot higher than DGRO's, and that makes a difference if you're someone who likes seeing real cash hit your account every quarter. It pays around $1.04 per share right now, and while its dividend growth is also very good, it lags slightly behind DGRO's. The fund is also extremely cost-effective, with a rock-bottom expense ratio of only 0.06%. It's large, too, managing over $69.93 billion in assets. That level of adoption points to strong investor confidence in SCHD's income strategy. And when you compare both to the S&P 500's 12.04% one-year return, you can clearly see the performance gap. DGRO came in at 10.42%, holding up fairly close and showing strong participation in the broader market rally. SCHD, on the other hand, delivered 3.97%, which is a much slower climb by comparison. That difference highlights how DGRO leans more into growth while SCHD is structured for income. While both are quality ETFs, they behave differently depending on what the market rewards in any given year. In the end, I'll walk you through a side-by-side projection that shows which of these ETFs could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. All right, so we've seen how these two ETFs have performed over time, but to really understand why they've performed the way they have, we need to look into the holdings. Because what each one actually owns tells you a lot about how it works and what kind of ride you're signing up for. Starting with DGRO. This one spreads its money out across 415 different companies. That's a lot of ground covered, and it means you're not relying too heavily on any single business to carry the weight. In terms of sectors, DGRO leans pretty heavily into financials at around 22%. Then tech takes up nearly 20%, and healthcare grabs about 15%. After that, you've got consumer staples, industrials, and utilities all showing up in decent amounts. There's also a sprinkle of exposure to energy, real estate, and a few other spots, but none of those smaller sectors make up more than 6% each. So there's nothing too lopsided here. And when you zoom in on the top holdings, the names all sound familiar. Microsoft leads the pack, followed by JP Morgan, Broadcom, Exxon, Johnson & Johnson, Apple, and a few others like Procter & Gamble and Home Depot. These are big, stable companies that don't just pay dividends, they've got a habit of raising them year after year. And even the top 10 stocks only make up about 26% of the whole fund, which keeps things well balanced. That's a big reason why DGRO tends to feel smooth and steady. Now, SCHD, it plays a tighter game. Instead of spreading its money across 400 companies like DGRO, SCHD sticks with just 103. That's a much more concentrated lineup, and it's very intentional. This fund doesn't try to own a little bit of everything. It's all about picking a smaller group of what it sees as the best, most reliable income machines out there. When you look at the sectors, SCHD leans heavily into consumer defensive stocks. That's stuff people keep buying no matter what, like food, drinks, or household goods. Right behind that is energy, and then healthcare. So already you're seeing a focus on essential industries with strong cash flows. It's also got decent slices of tech, industrials, and financials, and just a bit sprinkled across areas like communication and materials. But what stands out the most is how much weight it gives its top holdings. The biggest names? You've got Cisco, Coca-Cola, Verizon, Texas Instruments, Lockheed Martin, Altria, ConocoPhillips, Home Depot, Chevron, and Amgen. And here's the thing, those 10 companies make up over 41% of the whole fund. So when any one of them makes a big move up or down, SCHD feels it more. That can be a good thing when these stocks are doing well, but it also means SCHD is a bit more sensitive to individual company performance. In simple terms, DGRO spreads its bets widely with a growth-oriented tilt, while SCHD builds a high-conviction portfolio focused on quality dividend payers with strong fundamentals. And speaking of how much these ETFs pay you, let's talk about what really matters to a lot of investors: dividends, taxes, and that steady cash flow. For many investors, especially those looking at ETFs like DGRO and SCHD, the question isn't just how much will it grow, but how much will it pay me and what will I owe on that? Both DGRO and SCHD pay dividends quarterly, so you're receiving income 4 times a year. That's a big plus for people looking to build passive cash flow or reinvest their dividends over time. The big difference comes down to the size of those payouts. SCHD's current yield is 3.86%, while DGRO's sits at 2.19%. That means for every $10,000 invested, SCHD would pay out roughly $386 per year in dividends, while DGRO would generate closer to $219. If you're counting on those dividends as income either now or down the line, that gap matters. But dividends also come with taxes. For most U.S. investors, both DGRO and SCHD primarily pay out qualified dividends, which are taxed at the long-term capital gains rate, not ordinary income tax rates. That's good news. Still, if you're holding these in a taxable account, you'll need to report those dividends every year, even if you reinvest them. That's why many people choose to hold dividend ETFs inside tax-advantaged accounts like a Roth IRA or traditional IRA. In a Roth, your dividends grow tax-free. In a traditional IRA, you defer taxes until withdrawal. Both options help you get the most out of your reinvested dividends without losing a chunk to the IRS each year. In a couple of minutes, I'll walk you through a side-by-side projection that shows which of these ETFs could add an extra $2 million to your portfolio, pushing it past $5 million in value and generating more than $40,000 a month in dividends. But first, a piece of the puzzle that a lot of people skip over. How does it feel to own these things? Because numbers are great, but if your portfolio is making you lose sleep at night, that's a problem. Let's talk risk, volatility, and peace of mind. Now, both DGRO and SCHD are designed to be more stable than the overall market. That's part of the appeal. But they each go about it in slightly different ways, and the result? A different kind of ride for the investor. Starting with DGRO. It's kind of like that friend who never panics. Its standard deviation, which is just a fancy way of measuring how much the price moves around, is about 11.7. That's on the low side, meaning it tends to glide instead of jump. Its annual volatility? Around 15.1%. Again, that's pretty chill compared to the average ETF. So if you're someone who likes consistency, this is a fund that doesn't get too rattled when things get noisy in the market. DGRO also has a low turnover rate, only 25%. That means it's not constantly switching out stocks, which helps keep things more predictable, especially if you're holding it in a taxable account. Fewer trades mean fewer unexpected tax bills, and that's a win in anyone's book. And then there's tracking error, which tells you how closely the fund sticks to its intended index. Over 1 year, DGRO's tracking error is about 7.7%, and over 5 years, it drops to around 6.2%. Not perfect, but pretty solid. That consistency helps explain why DGRO feels like a smoother, more stable ride, not flashy, but dependable. SCHD, on the other hand, comes with a little more personality. It's not a roller coaster, but it definitely has more ups and downs compared to DGRO. SCHD's standard deviation, remember that's how much it tends to bounce around, is about 14.6, which is noticeably higher than DGRO's. Same goes for annual volatility, which clocks in at 16.3%. Still not extreme by market standards, but it does mean you'll probably notice the bumps a bit more, especially when the market gets shaky or interest rates start doing their thing. Its turnover rate is a bit higher too, sitting at 29%. Still relatively low, but it suggests SCHD does a bit more shuffling in the holdings. And more movement can sometimes mean more surprises when it comes to taxes or performance. Now, here's where things really stand out. SCHD's tracking error. Over the past year, it's been about 13.2%, and over 5 years, just under 10%. That tells us SCHD doesn't always stick super closely to its benchmark. It's not necessarily a bad thing, especially if the fund manager's strategy is working, but it does mean the result can sometimes drift a bit from what the index is doing. And remember how SCHD puts a big chunk of its money, over 40%, into just 10 companies? That kind of concentration can be powerful when those top names are doing great, but if one or two of them stumble, it can weigh down the entire fund. It's a double-edged sword. More focused potential, but also more exposure to single stock swings. From a technical standpoint, both funds score well. DGRO currently carries a strong buy rating, while SCHD is rated buy, showing strong momentum in both, but with more enthusiasm leaning toward DGRO. But of course, performance, cash flows, tax-smart strategies, and technical analysis are only part of the puzzle. If you're thinking long-term, like really long-term, the next question becomes, what happens to that $100,000 investment over 30 years? Let's run the numbers. Starting with DGRO, I'm working off some reasonable numbers collected based on the past 10 years' data, that your investment grows at about 9.08% a year in share price, with a 2.2% dividend yield, and that those dividends keep growing at roughly 12.5% per year. Based on these metrics, after 1 year, your $100,000 investment will be valued at $111,280. After 10 years, you'd be looking at $301,140. That alone would be impressive, tripling your money in a decade with no added contributions. But things really take off after that. By year 20, your portfolio would hit just under $1 million, $994,909. And by year 30, it explodes to $3.74 million, paying you nearly $16,000 per month in dividends. That's $191,300 a year just in income. A big chunk of that comes from those dividends being reinvested and compounding along the way. When you break it down, about $2.38 million of your total comes from capital appreciation, and another $1.25 million comes from reinvested dividends. So here's the big question, can SCHD beat that? Well, let's run the numbers. Same starting line, $100,000, but the numbers are just a little different. SCHD grows a bit slower on the price side, about 7.45% annually, but its dividend yield is higher at 3.87%, which grows at about 11.3% a year. No extra contributions, just time doing its thing. After the first year, your SCHD portfolio will grow to $111,320. Fast forward 10 years and you'll be at $312,338. 20 years in, your portfolio would climb to $1.17 million. And by year 30, you'd be looking at $5.78 million. That's nearly $2 million more than what DGRO delivered under the same time horizon. But it's not just the total value that grabs your attention, it's the income. By year 30, SCHD is projected to pay over $46,000 per month in dividends. That's $562,560 every year. So where's all that value coming from? About $2.5 million is capital growth, the rising share price over time. But a massive $3.17 million comes from reinvested dividends. That high yield, when paired with time and compounding, turns into an absolute powerhouse of income. So, which one is better, DGRO or SCHD? Between DGRO and SCHD, both are solid ETFs, but if we're calling a winner, especially from a long-term investor's point of view, SCHD takes the crown. Here's why. Over 30 years, SCHD turns $100,000 into roughly $5.78 million. DGRO, around $3.74 million. That's a $2 million difference. Even more important, SCHD's projected annual dividend income hits $562,000, or about $46,800 a month. DGRO, around $191,000 annually, or $15,900 a month. That's more than double the cash flow. Now sure, DGRO has smoother price swings and a slightly more diversified approach, but when you zoom out, when you really look at long-term value creation, SCHD's higher yield and compounding power just hit harder. So you're getting more income, more reinvestment, and more total return. So unless your number one goal is avoiding a few percentage points of volatility, SCHD is the ETF that builds wealth faster and pays you bigger over time. It's simple. More income, more total growth, more financial freedom. That's why SCHD wins. Retirement feels far away until one account choice shaves a full decade off the journey. And most people don't even know there's a difference. Today, I'm putting the Roth IRA and 401k head-to-head. I'll show you and John which one gets you close to a retirement fund of $1 million. I'm going to run real numbers, break down everything you need to know, and simplify it all in a way that actually makes sense. And in the end, I'll show you which of these two accounts will add an extra $90,000 to $100,000 to your retirement fund. All right, first, let's break down a Roth IRA in plain English. Think of it like this. You've got a jar. You fill that jar with money you've already paid taxes on, like money from your paycheck after taxes have been taken out. You'll never owe taxes on the profits when you pull it out in retirement. You put that money into your Roth IRA jar, then you let it sit. And while it's sitting there, it's not just hanging out, it's growing. Because inside that jar, you can invest in things like stocks, index funds, or ETFs. So the money has a chance to grow a lot over time. Now here's the special part. When you retire and take that money out, you don't have to pay any taxes on it. Not on your original money, not on the profits made. Nothing. Uncle Sam doesn't touch a dime of it. There are some rules, though. You can only put in up to $7,000 a year if you're under 50 in 2025, and there's a limit on how much income you can make to be eligible, $161,000 a year if you're single. If you earn more than that, there are still some ways to get money into a Roth, but that's another conversation. Also, you can't touch the earnings, the profit your money makes, without penalties until you're 59 and a half, unless it's for certain exceptions like a first-time home purchase. But, and this is big, you can take out the money you originally contributed anytime, tax and penalty-free. So if you put in $6,000 and need it 5 years from now, you can pull out that $6,000. You just can't touch the extra growth until retirement. One more thing people love about Roth IRAs, there's no rule forcing you to take the money out at a certain age. Most other retirement accounts require you to start withdrawing money by age 73, whether you need it or not. But with a Roth, you can leave it growing for as long as you want. So in short, you pay taxes now, let your money grow, and take it out later totally tax-free. It's simple, powerful, and gives you a lot of flexibility along the way. And that's what makes the Roth IRA such a fan favorite. But before we crown it the champion, let's see what the 401k brings to the table, because it comes with its own set of perks and surprises. Now the 401k. It's like having a retirement account with a built-in booster pack thanks to your employer's matching contributions. Here's how it works. You contribute a portion of your pre-tax income, and in many cases, your employer will match part of it. That's free money going directly into your retirement. Now, the big difference between a 401k and a Roth IRA is when you pay taxes. With a 401k, you're putting in money before it gets taxed. so it actually lowers your taxable income for the year. That might mean a smaller tax bill today, which is great if you want to keep more cash in your pocket right now. But here's the catch. When you retire and start taking that money out, Uncle Sam wants his share. Every dollar you withdraw gets taxed like regular income, so it's sort of a pay-later system compared to Roth's pay-now approach. As of 2025, you can contribute up to $23,000 a year if you're under 50. That's a lot more than a Roth IRA allows, which is one reason people really like 401ks. You can save a bigger chunk of your income, and with that employer match, the total can grow really fast. 401ks are great if you expect to be in a lower tax bracket later or if you want to get the biggest possible employer match. That said, there are a few trade-offs. Your investment options are usually limited to what your employer's plan offers. You don't get to pick just anything, like you can with a Roth IRA. And once you turn 73, the government says you have to start taking out a certain amount of money each year, whether you need it or not. These are called required minimum distributions, or RMDs. Still, if you're someone who thinks you'll be in a lower tax bracket when you retire, or if your company offers a solid match, a 401k can be a powerful tool to build wealth. It's like having a financial boost built right into your paycheck. So now that we've covered both options, the Roth IRA and the 401k, the big question is, which one actually gets you to retirement faster? Let's find out by putting them head-to-head with a real example using John. Let's say John works on Wall Street and makes $60,000 a year. He's 30 years old and has decided to put away 10% of his income, that's $6,000 a year, into a retirement account. His goal is to retire comfortably and spend his golden years sipping margaritas on a sunny beach. He's got two choices on the table, a Roth IRA or a 401k, but which one actually works better for him and leaves him more of the retirement balance? Now, John doesn't want to overthink it. He just wants to invest smart. If he chooses the Roth IRA, he'll pay taxes on that $6,000 now. But the money grows tax-free and he won't owe anything when he takes it out later in retirement. With the 401k, he gets a tax break now, meaning he'll pay tax on a $54,000 income instead of the full $60,000, resulting in less tax this year. But everything he takes out later will be taxed as regular income. There's also this little bonus with the 401k. His employer offers a 20% match. Now, to be super clear, most companies don't match 20% of your total salary. What we mean here is 20% of what the employee contributes to the 401k. So not 20% of John's total income. If John contributes $6,000 of his own money, a 20% match would mean the company adds 20% of that amount, $6,000, to his contribution, which comes out to $1,200. In real life, employer matches typically look something like this. We will match 100% of your contributions up to 3% of your salary, or we'll match 50% of your contributions up to 6% of your salary. So if you earn $60,000 and contribute $6,000 to your 401k, depending on the company's policy, you might get a match anywhere from $1,800 to $3,000 or more. But $1,200 is a fair, modest estimate for our comparison today. It's not meant to be a universal rule, just a simple number that helps us compare Roth IRA and 401k side by side in a way that's easy to follow. Now, Roth has a different kind of edge, flexibility. If something unexpected happens, John can pull out the money he originally contributed anytime, no penalty. With a 401k, that's trickier. If John touches the money before age 59 and a half, he could get hit with taxes and penalties unless he meets one of the few exceptions. So while the numbers matter, John also has to think about what kind of life he wants, how much flexibility he needs, and whether it's more important to have a tax break now or freedom later. So what does this mean in the real world? Over 30 years, these little differences add up in surprising ways. Taxes, employer matches, and even the way dividends are reinvested, they all behave differently depending on which account he chooses. But I'm not here to make it complicated. I'm going to keep everything else the same. One single investment portfolio used in both the Roth IRA and 401k so we can clearly see how each account type performs side by side. Now let's take a deeper look at how that investment grows in both accounts. And remember, in the end, I'll show you which one gets you close to a retirement fund of $1 million and which one will add an extra $90,000 to $100,000 to your retirement fund. To really understand how John's money grows in a Roth IRA versus a 401k, we need to zoom in on how each type of account handles investing and reinvestment. First, let's start with the basics. Both accounts allow investments in similar types of assets, stocks, ETFs, and mutual funds. The growth comes from two places: capital appreciation, which is the increase in the value of the investments, and dividends, which is the cash companies pay out to shareholders. John is going to reinvest all of his dividends, meaning he'll use all those payouts to buy more shares and compound his returns. Now let's make this as simple and fair as possible for John. We'll use the exact same investment portfolio in both the Roth IRA and the 401k to make a true side-by-side comparison. That way, the only differences come from how each account type handles taxes, contributions, and employer matching. So here's the portfolio we're going with. It's made up of 3 solid ETFs designed to provide a mix of growth, dividends, and global exposure. There's VTI, Vanguard Total Stock Market Index Fund ETF. This covers the entire U.S. stock market and has a strong history of long-term growth. It's got a dividend yield of around 1.25%, solid dividend growth, and a share appreciation rate of 10.42%. VXUS, Vanguard Total International Stock Index Fund ETF. This one adds international diversification outside the U.S., which helps reduce risk and smooth out returns. It pays a higher dividend yield at 2.88%, but its growth is a bit more modest at 2.81%. SCHD, the Schwab U.S. Dividend Equity ETF. This one focuses on high-quality dividend-paying U.S. companies. Its dividend yield is an impressive 3.96% with a very healthy dividend growth of over 11% and share appreciation near 7.26%. Here's what the portfolio looks like. Now let's find out the portfolio's metrics, and it's fairly simple. To figure out the average dividend yield for John's portfolio, we just look at the 3 ETFs he's using. Each one pays a different amount in dividends. VTI pays about 1.25%, VXUS pays 2.88%, and SCHD pays the most at 3.96%. So what do we do with these numbers? Well, you simply add them together, which gives us 8.09, then divide by 3 because there are 3 ETFs in this portfolio. That gives us an average dividend yield of 2.7%. And that number is basically how much income the whole portfolio pays out each year just from dividends. You can do the exact same thing to figure out the average for other metrics too. For this portfolio, the average dividend growth rate comes out to 7.05%, and the average share price growth is 6.83%. We'll also assume that John sticks with this same portfolio year after year, never pulling anything out early and just letting it grow without interruptions. No trying to time the market, no switching strategies, just steady, automated investing. By keeping the portfolio the same for both the Roth IRA and the 401k, we strip out all the extra noise and focus on what actually makes a difference. This way, we're not just comparing investments, we're comparing the effectiveness of the account types themselves. Now that we've got everything set up, here comes the exciting part, the actual numbers. We're going to see side by side how John's money grows over 30 years in both a Roth IRA and a 401k. The only thing that changes is the type of account. Everything else stays the same. So let's dive into the projections and find out which path brings John closer to his $1 million retirement goal. Starting with the Roth IRA. Let's say John consistently invests $6,000 every year into the portfolio using a Roth IRA and reinvests every single dividend he earns. In the first year, the balance just reflects his contribution, $6,000, but this is just the beginning. In year 10, his portfolio would reach $93,645. At the 20-year mark, his portfolio would have more than tripled, hitting $328,418. And by year 30, John's Roth IRA hits a solid $921,260. That final number breaks down like this. $524,024 comes from capital appreciation and $217,237 from reinvested dividends. Add in his total contributions of $180,000 over those 30 years, and the total value added to his portfolio is $741,260. And because it's a Roth IRA, none of it gets taxed when he withdraws in retirement. That means every dollar of those dividends, every bit of growth, it's all his to keep. Now let's see how John's 401k performs with that little extra boost from his employer. John starts by contributing $6,000 a year into each account, and in the case of the 401k, his employer adds an extra $1,200 annually. That is 20% of his contribution. Every dollar he invests is poured into the exact same portfolio, and every dividend is automatically reinvested. After 1 year, his account would have a value of $7,200. By the 10-year mark, John's 401k is looking pretty strong at $112,374. At year 20, it's grown to around $394,102. And by year 30, it climbs up over $1 million at $1,105,512. That number includes about $628,000 in growth from the value of his investments, plus another $260,000 from reinvested dividends and $36,000 from the employer contribution. And yes, that's the exact same total value added as the Roth IRA, $925,513. That's because the growth is coming from the exact same portfolio with the same habits. The difference? It's how the accounts handle taxes. Unlike the Roth IRA, the 401k is a pay-later plan. John didn't pay taxes when he put the money in, so now when he starts pulling money out in retirement, he owes taxes on every dollar. To keep it simple, let's say John is in a 25% tax bracket when he retires. That means he'll pay around $276,000 in taxes on his funds of $1,105,512. When you factor in the tax-free nature of the Roth IRA versus the taxable 401k, the gap between the two accounts narrows significantly. So here's what we got. Over 30 years, John has put the same amount into both accounts, $6,000 a year. The only difference? His 401k gets a little boost from his employer, $1,200 extra per year, bringing the total contributions there to $216,000 compared to $180,000 for the Roth IRA. Now, thanks to solid investments and compound growth, both accounts grow in a pretty big way. The Roth IRA final balance, $921,260. The 401k final balance before taxes, $1,105,512. So at first glance, it might look like the 401k is the clear winner. More money, right? But not so fast. Remember, the 401k is taxed when John pulls that money out. And if he's in a 25% tax bracket during retirement, he'll owe about $276,378 in taxes. So even though the account technically has over $1 million in it, what he actually gets to keep is about $829,134. Meanwhile, the Roth IRA is completely tax-free. That $921,260, all his. So when we compare what John actually walks away with Here's the final score. Roth IRA after taxes, $921,260. 401k after taxes, $829,134. The Roth IRA takes the crown with almost $92,000 more in John's pocket when it's all said and done. Now, sure, every person's situation is different. Tax brackets can change, and not every employer offers a match. But in John's case, and in many others, paying taxes up front and enjoying tax-free growth for life can be a game changer. John just inherited $1 million. He's in his 30s, has no dependents, no mortgage, and no burning desire to climb the corporate ladder. What he really wants is time. Time to travel, time to build something of his own, or maybe just breathe a little. And like many of us, his first thought is, well, what if I could live off the dividends? It sounds perfect. No boss, no meetings, just money showing up while you sleep. But the options, they're overwhelming. Some strategies are rock solid but pay very little. Others offer massive returns but come with serious risk. So John decides to test them all. In this video, we're going to walk through 7 different dividend strategies, starting with the safest and working our way up to the riskiest. We'll see what kind of income each one generates, and more importantly, what kind of life it actually supports. And in the end, I'll show you an asset that'll pay John $150,000 in yearly dividends right away. Let's start at the beginning with the most classic conservative choice there is: the dividend-paying blue-chip stocks. John starts with the most familiar, least risky name he can think of: Coca-Cola. It's iconic, global, timeless, and when it comes to dividends, few companies are more respected. That's what John wants first, a solid foundation, something safe. So he puts his full $1 million into Coca-Cola stock. With a dividend yield sitting at 2.97%, that gives him $29,700 a year. That's about $2,475 every month just in passive income. On paper, that sounds pretty decent, but let's look closer. At $2,475 a month, John could probably cover rent in a small apartment. He could buy groceries, keep the lights on, maybe cover a basic phone and internet plan, but that's about it. No vacations, no car payments, no money for hobbies, health insurance, or savings. This kind of dividend income doesn't buy freedom, it buys just enough to get by, with the constant need to stay cautious. The upside, Coca-Cola isn't going anywhere. Its revenue is steady, global demand is strong, and the dividend is among the most reliable on Wall Street. The check shows up every quarter without drama. But John can feel it, that low-level financial tension. There's no slack in the system, no margin for mistakes. One big bill, one health emergency, and things could spiral fast. And that's the irony. He's technically living off dividends, but barely living. This strategy is like using your $1 million to build a small, strong house with no windows. It's solid, but you can't see much of the world. You're protected, but you're not really free. John doesn't regret the test run, though. It gave him a baseline. Now he's wondering, what happens if I give up a little bit of safety for a little more room to breathe? Let's find out. After seeing what Coca-Cola could do, John doesn't want to jump straight into riskier waters, not yet. Instead, he looks for a step up in yield, but still within the world of safety. That's when he lands on Johnson & Johnson. It's a dividend king, a company that's increased its dividend for over 60 consecutive years. It operates in healthcare, consumer products, and pharmaceuticals. The current dividend yield for J&J is about 3.11%. So what happens when John invests his $1 million into J&J? Now his annual dividend income bumps up to $31,100, about $2,592 per month. That's a slight increase, only about $117 more per month compared to Coca-Cola, but it feels like something. A little more flexibility, a little more room to think. With $2,592 a month, John could afford a slightly nicer apartment, maybe a better neighborhood. He could pick up a small health insurance plan, maybe save a couple $100 a month instead of watching his balance flatline. But the core reality hasn't changed much. He's still budgeting every dollar, still living in survival mode with just a better mattress and maybe one takeout meal a week. The dividend is rock solid, and if safety is your number one priority, it's hard to beat. J&J has been through lawsuits, market crashes, industry shakeups, and the dividend just keeps climbing. But now John is starting to think in bigger terms. He's not just trying to not work, he's trying to live, do more, have more time and flexibility. He realizes that even ultra-reliable companies can only do so much, especially when the yields are modest. So, what if he stops picking individual stocks altogether and lets an entire portfolio of reliable companies do the work for him? Time to test out a different approach. John's getting the hang of this. After trying 2 individual stocks, he starts wondering, what if I let a basket of strong dividend companies do the work for me? That's where SCHD comes in, the Schwab U.S. Dividend Equity ETF. It's a dividend-focused ETF made up of companies with strong fundamentals, consistent dividend history, and solid cash flow. Think of it like getting a professionally curated playlist of top dividend payers without having to pick each stock yourself. SCHD's current yield is about 3.82%. John puts his entire million into SCHD, and with 3.82%, he's earning about $38,200 per year, or roughly $3,183 per month. Now we're getting somewhere. That's enough to cover all the essentials: rent, groceries, utilities, insurance, and still have some wiggle room. John can keep his car maintained, take the occasional weekend trip, maybe even treat himself to a new computer, a nice dinner once in a while, or even start contributing to a retirement account again. No more penny pinching, no more walking on financial eggshells. What's more, the ETF structure gives him built-in diversification. He's not relying on one company. If one business cuts its dividend, the others help smooth things out. It's a less emotional ride. But it's not total freedom. John still has to watch expenses, and there's not quite enough to feel totally comfortable if something goes sideways. A medical bill or a home repair could still derail things. And while 3.82% is much better than 2.97%, it still caps his income below the national median salary. So John's not disappointed. In fact, this is the first strategy that makes him feel almost independent, but the key word is almost. And now that he's seen what a little more yield can do, he wonders what's next. What if he leaned into a specific sector that's known for even higher dividends? He sets his sights on energy. Energy companies often throw off serious cash, and many return that cash to investors through generous dividends. The sector is cyclical, yes, but it's also built into everything: transportation, manufacturing, even electricity. John finds an ETF called USAI, the Pacer American Energy Independence ETF. It invests in U.S.-based energy infrastructure, including pipelines and natural gas companies, businesses that generate predictable contract-based cash flow. In USAI's case, the dividend yield comes in around 4.32%. So John decides to give it a shot. He puts in the full $1 million, and just like that, he's earning about $43,200 per year, or $3,600 every single month. This is a great start, a solid return from a dependable stock. But as we move up the ladder, both in risk and reward, things start to get a lot more interesting. I'm going to show you investments that pay even more, and in the end, I'll show you an asset that'll pay John $150,000 in yearly dividends right away. Back to USAI and $3,600 in monthly income. That's enough to live alone comfortably in most U.S. cities, cover all bills, keep a decent health insurance plan, and still save or invest a few $100s every month. He could afford weekend trips, upgrade some tech, eat out more often, and support a modest hobby, maybe photography, music, or design. His lifestyle is no longer survival-focused, it's flexible. But here's the catch. Energy is unpredictable. Geopolitics, oil prices, regulation, any of these can swing the sector. If earnings drop, so do dividends. And unlike broad ETFs, sector-specific ones don't always offer a cushion if one segment takes a hit. So while USAI gives John the best quality of life so far, it also introduces more uncertainty. Still, for the first time, John feels like he's actually in control. If he wanted to, he could cut back to part-time or even take a long break from work altogether. Sure, the road might get a little bumpy along the way, but with this kind of income coming in each month, it finally feels possible. But something's still bugging John. If a 4.32% yield from pipelines can give him this much ease, what if he could get this kind of cash flow but from something even more consistent, like rent? When most people hear the word rent, they immediately think of real estate. And yeah, so does John, but not the kind that comes with clogged toilets, noisy neighbors, or late-night repair calls. He's not looking to be anyone's landlord. He wants real estate that pays without the headaches. That's when he discovers Realty Income, ticker symbol O, also known as the Monthly Dividend Company. It's a REIT, a real estate investment trust, which basically means it owns things like retail buildings, medical offices, and warehouses, and rents them out to businesses on long-term leases. And because REITs are legally required to pay out 90% of their profits to shareholders, they're known for having some of the highest and most consistent dividend yields around. In Realty Income's case, that yield sits at around 5.68%. John moves his entire million into O, and just like that, he's earning $56,800 a year. That's nearly $4,733 per month. This is the first time things feel complete. With this income, John can live comfortably in most cities. He can pay for rent, utilities, groceries, insurance, car expenses, and still have room for travel, hobbies, and savings. He's no longer tiptoeing around every financial decision. He could comfortably stop working altogether or work part-time doing something meaningful. He could even consider starting a project he cares about, like a YouTube channel or a small e-commerce shop, purely for passion, not pressure. The best part, Realty Income has monthly payouts. That regular cash flow mimics a paycheck, making it feel more stable and manageable than quarterly dividends. But there are risks. REITs are sensitive to interest rates. If borrowing costs rise, property values can drop, and so can share prices. And while Realty Income is considered one of the safest REITs out there, it's still a sector-specific play, meaning if retail or commercial space hits trouble, income could dip. Still, John sees this as a major milestone. This is the first time it feels like dividends could actually support a real lifestyle, not just survival. But after seeing what a 5.68% yield could do, John starts wondering, well, what if I go just a little further up the yield curve? That leads him to a surprising pick, UPS, United Parcel Service. Yeah, the delivery giant with the big brown trucks. Not exactly what most people think of when they hear high dividend stock, but after a recent dividend bump, UPS is offering a yield of around 7.52%, and that catches John's attention. It's still a massive, well-established company with global operations and steady demand, but now it's paying more than some of the riskiest names out there. So John runs the math. $1 million in UPS would generate $75,200 per year. That's $6,267 a month. Well, that changes everything. Now we're in lifestyle territory. He could rent a bigger place, travel more often, treat himself without guilt, and even fund a creative side project like writing a book or building an app he's always talked about. He could help out family, support a charity, or just enjoy life without budgeting every penny. For the first time, the income isn't just covering life, it's creating space for joy, for freedom, for new possibilities. But this isn't a free ride. The shipping industry is cyclical. Economic slowdowns hurt volume, labor negotiations, fuel costs, and automation pressure margins. Not to mention a high dividend means a high payout ratio, which makes it vulnerable to cuts if cash flow dips. John realizes this isn't like Coca-Cola or Johnson & Johnson. This is a company that could surprise you in either direction. Still, the appeal is strong. With $75,000 a year, he could live well, build something, or do nothing at all, and do it without watching every penny. And now he's asking the question anyone else would ask at this point. What if I took this even further? Not 7%, not 8%. What if he went all in on something yielding 15%? It's bold, it's risky, but maybe it's the final step toward full-on freedom. John has seen what 7.5% can do, but what happens when you double that? That's when he comes across AGNC Investment Corp., a mortgage REIT that offers a dividend yield of around 15%. At first glance, it almost feels too good to be true, and in some ways it is. AGNC makes its money by investing in mortgage-backed securities, and while those can be stable and calm markets, they're also incredibly sensitive to things like interest rates, borrowing costs, and housing trends. When things go well, it's great, but when the tide turns, those big payouts, they can vanish fast. Still, John is curious, what would it look like if he leaned in completely? With $1 million invested in AGNC, he'd be bringing in a massive $150,000 a year, or $12,500 every single month. And now, with that income, the possibilities are endless. He could live anywhere in the world, take multiple international trips, support his family, and invest in anything he cares about. He could take 5 years off if he wanted. He could live stress-free if the income lasts. And that is a big if. Mortgage REITs like AGNC are notoriously unstable. Their dividends fluctuate, their share prices can drop sharply in a bad year. And while 15% sounds like magic, it's also the yield of desperation, a payout that may not be sustainable in the long term. John knows this. He reads the warnings. He sees the risks. And yet, the possibility lingers. This is the only strategy that would give him everything he wants right now. Complete freedom, but with a ticking clock. So the real question here isn't, can I live off this? It's how long can I count on it? For John, that uncertainty outweighs the temptation, and it leads to a deeper realization. Freedom doesn't come from chasing the biggest number. It comes from finding a number that you can rely on and live with. $20 doesn't feel like much. It comes and goes, coffee here, delivery there. But what if I told you that that same amount, when invested in a carefully selected portfolio, could generate over $7,000 in monthly dividend income? Sounds too good to be true? Well, in this video, I'll show you how to make it happen. I'll show you and John how to select specific stocks for this target. I'll show you the secret to dividend investing. And in the end, I'll show you how a portfolio of these stocks can turn a $20 a week investment into an $800,000 portfolio that'll pay you over $7,000 in monthly dividend income. But first, let's take a step back and understand the concept. Let's start with the basics, because if you're going to build your future around dividend investing, it needs to make sense right from the start. A dividend is essentially your slice of a company's profits. When you own shares in a business that pays dividends, they send you a portion of their earnings just for holding on to their stock. No selling, no trading, no extra effort. That's what a dividend stock does. It puts money in your pocket simply for being an owner. Now, some people buy stocks hoping the price will skyrocket. That's called capital appreciation. And while it can be exciting, it's unpredictable. Dividend investing flips the mindset. Instead of hoping your stock jumps in price, you're building a portfolio designed to pay you regularly and reliably, regardless of what the market's doing. That money can be used however you want. Reinvest it, pay bills, fund your lifestyle. Over time, as you add more shares and companies grow their payouts, those dividend checks can grow from a trickle into a river. Dividend investing isn't just about getting rich. It's about creating cash flow. It's about turning your money into a quiet worker that sends you income every single month, even while you sleep. And the best part, anyone can do it. You don't need thousands of dollars to start, just the right approach, the right stocks, and a bit of patience. Now, when it comes to dividend investing, there are two main strategies: dividend reinvestment plans, or DRIP, and non-DRIP investments. To reach the $7,000 per month income with only a $20 a week contribution, you need to know how this works. Let's start with what happens when you don't reinvest your dividends. This is what's called a non-DRIP investment. Here's how it works. When you own shares in a company that pays dividends, they'll send you cash regularly, usually every few months. That money shows up right in your account, and you can do whatever you want with it. Spend it, save it, or put it somewhere else. It's your call. Now let's say you invest $1,000 in a stock that pays a 5% dividend. That means you'll earn $50 per year in dividend income. But if you just take that $50 in cash and don't reinvest it, your investment stays right at $1,000. And every year, as long as the company keeps paying the same dividend, you'll keep getting that same $50. It's consistent, but it doesn't grow on its own. Now let's look at the DRIP strategy, which stands for Dividend Reinvestment Plan. And this is where the real magic starts. With DRIP, instead of taking your dividend payments as cash, those payments automatically get used to buy more shares of the same stock. So say you invest $1,000 into a stock that costs $20 per share. That means you now own 50 shares. Like before, let's say that stock pays a 5% dividend, which comes out to $50 a year based on your $1,000 investment. If you choose DRIP, the Dividend Reinvestment Plan, here's what happens with those dividends. In year one, instead of pocketing that $50, it automatically gets used to buy more of the same stock. Since each share is $20, your $50 buys you 2.5 more shares. So now you own 52.5 shares. So in year two, your dividends aren't based on 50 shares anymore, they're based on 52.5 shares. And you now earn around $52.50 in dividends. That buys you 2.6 more shares, bringing you up to 55.1 shares, which means by year 3, you're now earning dividends on 55.1 shares, which gives you about $55.10. That buys you roughly 2.75 more shares, bringing your total up to 57.85 shares. So in just 3 years, your share count has gone from 50 to nearly 58 without you adding a single extra dollar from your pocket. And that's with just a steady 5% dividend and no change in the stock price. Now imagine that same effect continuing every single year, and on top of that, if the stock price goes up, or if the company increases its dividend, which many good companies do, that snowball starts rolling even faster. This is how DRIP works. Your money earns more money, which buys more shares, which earn even more money. It's slow at first, yes, but give it time, and it turns into something really powerful. Now, let's see these strategies in a side-by-side comparison. Let's look at the dividend income alone over these 3 years. In the non-DRIP path, you collected $150 total, $50 a year, plain and simple. But with DRIP, by reinvesting your dividends every year, your annual payouts started to rise. By the end of year 3, you'd earned $157.60 in total dividends. That's about $7.60 more than the non-DRIP route. Now sure, that might not seem like a big deal yet, but remember, this is just 3 years. That extra $7.60 didn't come from you adding more money, it came from the shares your dividends purchased in previous years. And guess what? Those new shares are going to keep paying dividends too, which will buy even more shares, and so on. The longer you let this cycle run, the bigger the gap becomes. It starts slow, but over 10, 20, or 30 years, that snowflake turns into a snowball of passive income. I'm talking tens of thousands of dollars more, all because you chose DRIP from day one. And this is the secret to dividend investing. So now that you understand how DRIP turns passive income into exponential growth, let's look into how to pick the right stocks that'll help you reach your income goals. This strategy is built on consistency, so I used a very specific set of filters that favor long-term reliability, growing income, and steady appreciation. The first thing I looked at was the dividend yield, basically how much cash you get back every year from your investment. A strong yield means your money is already working to generate income. But a high yield by itself doesn't tell the whole story. Sometimes high yields are red flags, like the company's in trouble and trying to attract investors. That's why the second metric, dividend growth rate, was even more important. I focused on companies with a proven track record of increasing their payouts year after year. Think of this like giving yourself a raise every 12 months without having to ask for one. The higher and more consistent the growth, the faster your income compounds. Then I looked at the share price appreciation. While our focus is income, we still want our investments to grow in value. Strong capital appreciation increases your overall wealth and boosts the effect of reinvested dividends. But beyond the numbers, I also considered business strength and industry leadership, consistently profitable companies that have been operating for decades with a strong brand or market position. These are the ones we wanted. And finally, I focused on diversification. I didn't pick all high-yield stocks or all high-growth companies. I combined both. The goal was a portfolio that pays well now and grows like crazy over time. Next, I'll show you how I selected the stocks based on this exact criteria, and then I'll show you how the portfolio I built can turn a $20 a week investment into an $800,000 portfolio that pays you over $7,000 a month in dividend income. But first, the stocks I selected. Based on the criteria, the following 5 stocks have been carefully chosen for their ability to generate reliable income as well as their potential for long-term growth. Each one plays a unique role in building a portfolio that works quietly in the background, compounding your money into something powerful. Let's start with Extra Space Storage with the ticker symbol EXR. This company is the largest operator of self-storage properties in the U.S. Based in Utah, EXR owns or manages over 4,000 storage locations in 43 states. What makes this business attractive is its durability. People always need storage. Whether they're moving, downsizing, or running a small business, self-storage demand is consistent. EXR has a 4.38% dividend yield, has grown those dividends by 12.47% on average each year over the past decade. And on top of that, the stock itself has appreciated by 7.74% per year. Next, Lowe's Companies with the ticker symbol LOW. This retail giant has been around since 1921 and has become a go-to for home improvement needs. From lumber to lighting to landscaping, Lowe's supports both DIY homeowners and professional contractors. What I love about Lowe's is that home improvement isn't a trend, it's a lifelong need. As homes age, as families grow, as people stay put, instead of moving, they invest in where they live. Lowe brings a 2.19% dividend yield, a remarkable 17.46% 10-year dividend growth rate, and 12.68% annual share price appreciation, making it a long-term wealth builder. On to the next stock, NetEase with the ticker symbol NTES. Based in China, NetEase is a tech conglomerate with global reach. It operates in online gaming, music streaming, educational tech, and smart devices. This multi-pronged business model brings both innovation and diversification. NTES pays a 2.03% dividend yield, shows a massive 24.79% dividend growth rate, and offers 16.25% in annual share price appreciation. It's my high-growth pick, helping supercharge long-term results while adding some international exposure. Fourth is the Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. This is the core stabilizer. SCHD holds a basket of top-performing U.S. dividend stocks, all vetted for strong financials and consistency. With SCHD, you get instant diversification across major industries without needing to buy 100 different individual stocks. It pays a 3.79% dividend yield, grows dividends at 10.77%, and has an annual share price appreciation of 7.64%. For investors who prefer something hands-off, SCHD is the ideal foundation. Lastly, Kroger with the ticker symbol KR. This grocery and pharmacy giant has been in business since 1883. It operates thousands of stores and fuel stations, providing everyday essentials to millions. In good times and bad, people buy groceries, which makes KR a low-volatility, recession-resistant stock. It pays a 1.96% dividend yield, has shown 13.52% dividend growth, and an annual share price appreciation of 6.71%. Kroger keeps the portfolio grounded while still delivering growth. So now that we have 5 stocks selected, the next step is to calculate our portfolio dividend yield, dividend growth, and price appreciation. And it's fairly simple to do this. Let's start with dividend yield. Each stock in your portfolio pays out a certain percentage of its value in dividends every year. To figure out the average dividend yield across all 5 stocks in our portfolio, you simply take each stock's dividend yield, add them together, and divide by 5. For example, EXR currently pays a 4.38% dividend yield. Low pays 2.19%, NTES is at 2.03%, SCHD pays 3.79%, and KR pays 1.96%. To get the average dividend yield of the whole portfolio, you simply add those numbers together and divide by 5. So that's 4.38 plus 2.19 plus 2.03 plus 3.79 plus 1.96, which adds up to 14.35%. Divide that by 5, and you get our portfolio dividend yield of 2.87%. You can follow the exact same steps to calculate dividend growth, which is the rate at which those dividends have increased over the past decade. Add up the 10-year dividend growth rates for all 5 companies, divide by 5, and you get the portfolio's average dividend growth, which for this portfolio is 15.8%. Do the same for the average share price appreciation, and we get 10.2% for the portfolio. This combination gives you a portfolio that works in 3 dimensions: paying you now, growing your income over time, and building wealth through appreciation. So what does this actually mean for your money? Let's say you stay consistent and invest $20 a week in this portfolio over time. After 1 year, you would have saved up $1,040. This sets the stage for future investment and growth. After 5 years, your weekly contribution, along with capital appreciation and dividend reinvestments, will be valued at $6,817. In 10 years, your portfolio would grow to $20,326. Give it 10 more years, and your investment after 20 years will be valued at $117,813. This is when the compounding effect takes full effect, and after 30 years, your portfolio would be valued at $837,511. At the same time, you'd be receiving $93,905 per year in dividends, or around $7,825 per month, just from your $20 per week investment. The total value added to your portfolio would be $806,311, with $385,426 coming from capital appreciation and $420,886 from dividend reinvestment. What if I told you one simple investment could potentially turn $100,000 into over $3.5 million? And no, it's not crypto, options, or some hidden loophole. It's 5 index funds from Charles Schwab. Boring? Maybe. Effective? You're about to see just how much. Today I'm breaking down what happens when you invest $100,000 into Schwab's 5 top index funds. I'll show you how they could potentially turn $100,000 into over $500,000, $2 million, and in the end, I'll show you a Schwab index fund that has the potential to turn that investment into a $3.5 million valuation while paying over $20,000 in monthly dividends. Now, before we dive into the numbers, let's take a second to talk about why Charles Schwab and how I picked these 5 funds out of literally hundreds of options out there. Let's start with Schwab itself. Charles Schwab has built a rock-solid reputation as one of the most trusted, low-cost investment platforms in the world. Their index funds have no loads, no commissions, and some of the lowest expense ratios you'll find anywhere. For long-term investors, that means more of your money stays invested, compounding for decades. But it's not just about fees. Schwab offers broad diversification, transparent fund construction, and a track record of performance that rivals the biggest players in the game. Whether you're starting with $100 or $100,000, Schwab makes it easy to get in and stay in for the long haul. So how do I pick these 5 index funds? I followed a simple but powerful process. First, I looked at dividends, not just the current yield, but how fast those dividends have been growing over the past decade. Then I factored in historical share price appreciation to see how much long-term value each fund has delivered year after year. I also paid close attention to how each fund is structured. Are they market cap weighted or fundamentally weighted? Do they automatically rebalance? These features might sound technical, but they actually tell you a lot about how a fund reacts during different market cycles. My goal is to strike that perfect balance between growth and income. I focused on funds that consistently pay dividends, grow those dividends over time, and still offer solid capital appreciation. And I didn't want to be limited to just US stocks, so I made sure to include both international and domestic exposure. Finally, I added one fund that's a bit different, a target date fund that automatically adjusts its risk as you approach retirement. It gradually gets more conservative over time without you having to do a thing. All 5 of these funds are easy to access, cost-efficient, and built for hands-off wealth building. Number 5 on my list, a globally diversified index fund that spreads your money across developed economies around the world. The Schwab International Index Fund with the ticker symbol SWISX. Now, if you've ever felt like investing overseas sounds complicated, this fund makes it simple. Instead of trying to pick individual stocks in foreign markets, which, let's be honest, most of us don't have the time or expertise for, SWISX gives you instant access to over 700 companies from developed economies around the world. Europe, Australia, Japan, it's all in there. It invests in both growth and value stocks across sectors like banking, manufacturing, technology, and healthcare. The fund uses full replication, which means it owns virtually every stock in the index, giving investors broad, hands-off access to the world's most developed economies. Its sector exposure is remarkably well-balanced. Financials make up about 22%, industrials are just under 19%, healthcare is at 11%, and tech comes in close to 10%. The rest, industries like consumer goods, communication, and energy, all add smaller slices to the pie. That kind of balance really helps, because if one sector takes a hit, chances are another one is holding steady or even pulling ahead. And when you zoom into the top holdings, it's a lineup of household names: SAP, ASML, Nestle, Novartis, Roche, companies with real staying power. An important thing to note here is that the top 10 make up just 12 to 13% of the fund. That is super diversified. No one company can drag your entire investment down, and that's exactly what you want when you're thinking long term. Also, the fund comes with a super low expense ratio of just 0.06%, making it one of the most cost-effective ways to access international stocks. Over the past year, SWISX has returned 15.02%. Over 5 years, it was up 44.11%, and across the past decade, it's delivered a total return of 39.11%. These aren't sky-high returns, but they're steady and supported by both dividend payouts and global equity growth. So let's plug in the numbers here. What happens if you put $100,000 into this fund? Right now, SWISX has a dividend yield of 2.66%, with dividend payouts growing at an average of 4.64% per year. Its share price has been steadily climbing too, with an average annual return of 3.79%. So let's say John invested $100,000 and the fund manages to maintain the same performance in the future. After 1 year, his portfolio could potentially reach around $106,450. Stick with it for 10 years, and it might grow to roughly $188,669. After 20 years, the investment could be valued at $364,200. And after 30 years, it has the potential to reach $720,726 in valuation. By then, the annual dividend income might land somewhere around $22,861. That's close to $1,905 per month. Looking at the full 30-year projection, John's initial $100,000 investment would add a total value of $620,726. Out of that, $339,709 comes purely from capital appreciation, while $281,018 results from reinvested dividends. Next, at number 4, we have the Schwab Fundamental International Equity Index Fund with the ticker symbol SFNNX. It takes a different approach than traditional market cap-weighted funds. Instead of focusing on the size of a company's stock price or market cap, this fund selects and weights stocks based on real business fundamentals, things like cash flow, dividends, and total sales. It's designed to capture the actual economic strengths of companies. Launched in 2007, this fund follows a benchmark called the Roth Fundamental High Liquidity Developed ex-US Large Index. Sounds complicated, but here's the simple version. It invests in large companies across developed countries outside the US, and it's constantly adjusting. If a stock gets too expensive compared to its fundamentals, it gets trimmed back. If a company starts performing better, it gets more weight. Right now, SFNNX holds a massive lineup of 943 companies, and the beauty is no single stock takes over the spotlight. The top 10 only make up about 11.61% of the entire fund, so your money stays spread out and balanced. Names like Shell, Samsung, Total Energies, and Toyota sit at the top, but even they hold just small slices of the pie. Other familiar players like HSBC, Nestle, Roche, Santander, and BP round it out, all staying well under 1% each. And when you look at sectors, the focus leans toward the traditional side. Financials and industrials take the lead, followed by consumer cyclicals, materials, and energy. There's still a solid slice of tech and healthcare, but overall, the fund leans more toward value, which can be a good thing when markets get shaky. With nearly $3.6 billion in assets and a turnover rate of just 12%, SFNNX is both popular and surprisingly efficient. It doesn't trade too often, which helps keep things stable, and even with its more hands-on, fundamentals-first strategy, the expense ratio sits at just 0.25%. Not the cheapest, but still very reasonable for what it delivers. As for the performance, over the past year, the fund returned 16.26%. Over 5 years, it's up 66.54%. And across the last decade, the total return has hit 49.6%. Now here's where it really starts to add up. Right now, SFNNX offers a dividend yield of 2.87%, which is higher than what you'll find in a lot of broad market funds. And even better, those payouts have been growing at about 5.34% per year over the last decade. And then there's the average share price growth of 4.34%. So let's say John put $100,000 into this fund. After 1 year, his portfolio could reach $107,210. At the 10-year mark, it might grow to $203,106. After 20 years, he'd be looking at around $424,751. And if he stayed invested for 30 years, that single investment could grow into a $917,326 portfolio. That includes $452,437 in capital appreciation and $364,889 from reinvested dividends, adding a total of $817,326 in value over the original investment. And if John were living off income at that point, his projected annual dividends would be $32,480 or about $2,707 per month. Solid return, but not $1 million return. In a couple of minutes, I'll show you an index fund that reaches the $1 million goal, and after that, I'll show you a Schwab index fund that has the potential to turn a $100,000 stake into a $3.5 million portfolio that pays over $20,000 in monthly dividend income. Up next, let's see how the U.S. total market stacks up. At number 3, we have the Schwab Total Stock Market Index Fund with the ticker symbol SWTSX. This fund gives you full exposure to the entire U.S. stock market. That means it doesn't just focus on the giants, it includes large cap, mid cap, and small cap companies across every sector. If it's publicly traded in the US, chances are it's in the fund. SWTSX tracks the Dow Jones US Total Stock Market Index using a full replication strategy, which simply means it actually owns all the stocks in the index, not just a slice. In short, with this fund, from tech to energy to healthcare, you're basically owning a piece of the whole US economy in one simple investment. It's been doing this since 1999, and over the years, it's become a go-to choice for anyone who wants broad, no-nonsense exposure to the American market, all with the simplicity and low costs that Schwab is known for. SWTSX is basically a snapshot of the US economy, and its performance proves it. In just the past year, it's grown by 16.98%, with momentum picking up as the market recovered in mid-2025. Zoom out a bit, and the numbers get even more impressive. Up 91.83% over the last 5 years and 178.74% over the past decade. And it's not just strong, it's efficient. The fund has one of the lowest expense ratios out there at just 0.03%. Plus, with a turnover rate of only 2%, it sticks with its holdings, keeping things stable and hands-off for long-term investors. The fund holds a massive 3,036 different stocks, which gives you serious diversification. Now, even though the top 10 names take up about 31.91% of the portfolio, the rest is spread across thousands of companies, giving you a really wide base. Tech leads the way, making up about a third of the fund, 32.73% to be exact. Then come financials at 14%, consumer cyclical stocks at just over 10%, and healthcare, communication, and industrials all sitting between 8 and 10%. The rest of your investment gets spread across everything from real estate to energy and utilities. At the top of the list, you've got the usual heavy hitters: Nvidia, Microsoft, Apple, and Amazon. Meta, Alphabet, Berkshire Hathaway, Tesla, all the big names are there. But with thousands of other companies alongside them, you're not just betting on a few tech giants, you're buying into the entire US market story. Right now, SWTSX has a dividend yield of 1.14%, and those payouts have been growing at an average of 5.8% each year. Combine that with long-term annual share price growth of 11.09%, and you've got a strong mix, perfect for long-term investors. So let's say John invested $100,000 in this fund and left it untouched. After 1 year, his portfolio would grow to about $112,230. Stick with it for 10 years, and it might reach $310,404. After 20 years, we're talking $931,410, and if he stays the course for 30 years, that investment could potentially grow to a massive $2,740,225. So the total value added over that time could reach $2,640,225, with about $2,552,155 coming from share price growth alone and another $88,071 from reinvested dividends. So that's the US total market. But what if you narrowed the focus, investing in America's biggest, most dominant companies? That's exactly what the next index fund is all about. The Schwab S&P 500 Index Fund with the ticker symbol SWPPX. It's one of the most trusted vehicles for passive investors looking to gain exposure to America's largest, most dominant businesses. This fund tracks the S&P 500, which includes 504 of the largest and most influential publicly traded companies in the U.S. It's been around since 1997, and with an expense ratio of just 0.02%, it is one of the cheapest ways to invest in America's top-tier companies. If you're looking for simplicity, broad diversification, and consistent performance, this is about as straightforward as it gets. SWPPX is powered by a portfolio of giants, the kind of companies that shape the U.S. economy. Tech leads the way, making up 34.36% of the fund. That's no surprise, considering how much innovation and growth are driven by the tech sector. After that, you've got financials at 13.67%, consumer cyclicals at 10.54%, followed by communication services, healthcare, and industrials. The top 10 holdings make up about 36.35% of the fund. That includes heavyweights like Nvidia at 7.29%, Microsoft at 6.99%, and Apple at 5.79%. Amazon, Meta, Broadcom, Alphabet, both Class A and C shares, Berkshire Hathaway, and Tesla round out the list, each holding a solid chunk. Now, that level of concentration might sound high at first, but these are dominant, cash-rich businesses with massive global reach, and they're the backbone of the modern economy. Performance-wise, SWPPX has been nothing short of impressive. In the past year alone, it's gained 17.39%. Over 5 years, it's up 97.93%, and across the last decade, a massive 196% return. Now let's look at what that kind of long-term growth could actually mean for your money. Right now, SWPPX comes with a dividend yield of 1.13%, and those payouts have grown at an average of 5.02% per year. On top of that, the share price has averaged 11.66% annual growth. So if John invested $100,000 into SWPPX after just 1 year, his portfolio could grow to around $112,790. Fast forward 10 years, and it might be worth $324,894. After 20 years, it could reach $1,016,791. And if he stays invested for the full 30 years, that one-time investment has the potential to grow into a massive $3,122,653. Most of that growth, about $2.9 million, would come from the share price alone. Reinvested dividends would add another $72,870. And by year 30, the portfolio would be generating around $4,303 per year. Great growth, solid returns. But if you're looking for dividend income down the line, this next one takes the crown. At number 1, we have the Schwab Target 2045 Index Fund with the ticker SWYHX. This fund is built for people planning to retire around the year 2045, but honestly, anyone with a long time horizon can benefit from how it's structured. What makes it unique is that it's designed to change with you. Right now, it leans into growth, but as the years go by and 2045 gets closer, it slowly shifts towards more conservative, income-focused investments. You don't have to do a thing here. It handles the adjustments automatically. It's made up of other Schwab ETFs, so from day one, you're diversified across different asset classes, sectors, and even countries. Stocks, bonds, real estate, all wrapped into one easy fund that evolves as you move through different stages of life. Looking at the fund's historical performance, it delivered a 13.51% return over the past year, 55.51% over 5 years, and 103.77% over the last decade. That's solid, considering it balances growth and stability. The fund currently manages $886.16 million in assets, maintains a low expense ratio of 0.08%, and has a 14% turnover ratio. Right now, SWYHX is still in its growth phase, meaning it's heavier on stocks than bonds. Most of the fund is made up of the Schwab U.S. Large Cap and International Equity ETFs, giving it strong exposure to big companies in the U.S. and around the world. It also includes small caps, emerging markets, and real estate, all focused on growth. The bond portion is still relatively small, which makes sense for a fund designed for people retiring around 2045. Even though it's in its growth phase, it has a solid dividend track record. Right now, it has a dividend yield of 1.92%, and those dividends have been growing at a rapid pace, with a 10-year CAGR of 13.49%. Combined with an average annual share price return of 8.21%, this fund brings both strong long-term growth and rising income to the table. If John invested $100,000 into SWYHX after 1 year, his portfolio could grow to around $110,130. In 10 years, it could be valued at $275,268. In 20 years, he might be looking at $878,233, and after 30 years, that one-time investment could potentially reach a valuation of $3,569,252. The total value added to the portfolio? A massive $3,469,252. Of that total, $1,509,912 would come from dividend reinvestment alone, and $1,959,341 from capital appreciation. As for the dividends, by the 30-year mark, this portfolio could be paying out around $261,012 per year, or about $21,751 per month in income. Your bills show up every week, so why does your portfolio pay you once a quarter? That's what I'm building in this video, a weekly income system using 12 high-yield dividend stocks, each one timed to pay you during a different week of the month. I'll walk you and John through why each one earns its place in the lineup, how they complement each other, and how the timing of their payouts keeps the cash flowing every week. In the end, I'll show you how this portfolio and strategy can pay on average $300 to $400 from the first week. Let's start by talking about why this strategy makes so much sense in today's economy and why dividend investing is more powerful now than it's ever been. Okay, so before we jump into the actual stocks, let's take a second to talk about what's actually going on in the economy right now and why dividends matter more than ever. Let's be real, prices are high. Groceries, gas, rent, it all adds up. Inflation hasn't just disappeared, and even though interest rates have shot up, they're not exactly helping the average person save or borrow. On top of that, global tensions are back in the spotlight. New trade wars, tariff easing, but still there are threats and political uncertainty. It's no wonder that markets feel like they're swinging every other day. People are looking for something steady, but all they're getting is chaos. And that's where dividend investing really starts to shine. Because at its core, it's pretty straightforward. You buy into companies that literally pay you to hold their stock. That's it. No wild trading, no timing the market, no sweating over daily stock charts. You just hold and get paid. And here's the key, that income doesn't rely on the market going up. It just depends on owning the right companies. And what makes it even better is consistency. While those flashy growth stocks go up one week and crash the next, dividend-paying companies are usually more stable. They're not chasing headlines. They're built on habits, like reliably sending out checks to their shareholders quarter after quarter, year after year. The problem is that with all of life's responsibilities, not everyone can live from quarter to quarter, waiting on those quarterly earnings. But here's the part that surprises most people. With the right mix of dividend stocks, you can actually structure those payments to hit your account every single week. Not once a quarter, not once a month, weekly, like a paycheck. And that changes everything. Suddenly, you've got a rhythm, a cash flow system, something that feels steady even when the market is spinning like a top. Now, not all dividend stocks are worth your money. A high yield might look great on paper, but if the company's built on shaky ground, it won't last. You want the ones with strong foundations, real businesses, real cash flow. Of course, chasing weekly stocks means you'll be exposed to some level of risk. The good news, I've done all the digging, so let me walk you through how to build that kind of weekly dividend income step by step. Instead of just buying one or two stocks that toss you a check every few months, we're doing something smarter. We're building a rotation, a lineup of 12 solid high-yield dividend stocks. But here's the trick. Each one pays out at a different time during the month. That way, every single week, something is hitting your account. Think of it like a smooth baton pass in a relay race. One stock pays you, the next one takes over the following week, then the next, on and on. It's steady, it's predictable, and it turns your portfolio into a weekly income machine. No more waiting around for that one quarterly payout. This way, your money shows up like clockwork every single week. But I'm not just picking random stocks with high yields. Every name on this list checks 3 important boxes: strong dividend yield, financial health, and industry variety. That last one's a big deal because if one sector slows down, others keep the income flowing. It's like having backup generators in different parts of your portfolio. This isn't about chasing hype. It's about building something that lasts, something that keeps paying you whether the market's booming or barely crawling. And the best part? You don't need to be glued to your phone or constantly watching the market. This system runs in the background. Once it's set up, it just works. Your only job? Follow the plan and let the payouts come in. And as they do, you can even reinvest them, growing your income stream little by little without adding more money out of your own pocket, or simply use them for your expenses. So let's jump into the first batch of stocks, the ones that kick off your income stream every quarter: January, April, July, and October. Each stock is placed in a specific week to keep your income steady and uninterrupted. Let's start with week 1, Conwest Associates LP units with the ticker symbol CWPS, which comes in with a powerful yield of 13.17%. CWPS isn't just about a big percentage, it's also about consistent performance. It starts your quarter strong. This stock delivers its payout early in the month, setting the tone for reliable income right out of the gate. In week 2, Brandywine Realty Trust with the ticker symbol BDN has a dividend yield of 14.93%. It's a real estate investment trust that has a long history of paying solid dividends. Mid-month can often feel like a quiet stretch, but BDN fills that gap with a dependable deposit. You stay on track with zero downtime between payouts. Next is week 3, Office Properties Income Trust with the ticker symbol OPI offering a dividend yield of 17.28%. OPI focuses on office properties. Despite the sector's challenges, it maintained its distributions and held firm. That kind of consistency is key to making this whole system work, especially in an environment where surprises are common. And finally, we close the month with week 4, Two Harbors Investment Corp. with a ticker symbol TWO, which boasts the highest yield in this group at 15.46%. TWO operates in the mortgage space and is known for delivering one of the most generous payouts among high-yield dividend stocks. Now, here's what makes this whole setup so effective. Each of these stocks pays quarterly, but because they're spread out across different weeks, you're not just getting paid every few months, you're getting something every week. Then you repeat the cycle again in April, July, and October. And there's a nice layer of protection built in too. BDN and OPI give you exposure to commercial real estate, while CWPS brings in preferred shares, and TWO adds a mortgage-backed angle. So even if one area takes a hit, the others help smooth things out. Now remember, in the end, I'll explain how these stocks with the rest of the portfolio and strategy are capable of paying out an average of $300 to $400 right from the beginning. So let's keep going, because the next set of months, February, May, August, and November, are just as important to keeping that weekly cash flow alive. These aren't usually seen as major dividend months, but in this rotation they play an equally important role. The second group of stocks keeps the weekly payouts moving without missing a beat. We kick off week 1 with Angel Oak Mortgage REIT with the ticker symbol AOMR. It's not flashy, and honestly, it doesn't need to be. AOMR focuses on real estate-backed mortgage assets and delivers a solid 13.09% yield. What it brings to the table is stability. It just does the job, pays consistently without drama, and that's exactly what you want when you're aiming for predictable cash flow. Moving into week 2, TXO Partners takes over. That's TXO on the ticker, and it pays a 12.84% yield. TXO is part of the oil and gas world, and while that sector can move with the market, well-run companies in this space are usually strong cash machines. TXO adds that dependable energy income while also giving your portfolio some fresh legs beyond real estate. Week 3 is where Flex LNG comes in, ticker FLNG, with a yield of 11.98%. This company is in the business of liquefied natural gas shipping. Sounds niche, but here's why it matters. Global energy demand keeps rising, and LNG is a big part of meeting it. FLNG gives your strategy some international exposure and taps into long-term global trends. Then to round out the month, we've got Alliance Resource Partners, ARLP, closing week 4 with a 9.8% yield. This one's in the coal and broader energy sector. Now, coal might not be the buzziest investment out there, but ARLP has a strong record of paying dividends, and in this system, that reliability is what counts. It's not about hype. It's about income that shows up when you expect it. This group also improves balance. With energy, shipping, and real assets now in play, the portfolio isn't relying too heavily on one type of business. If one sector slips, others help keep the income going. That balance is key to keeping the system running through different market conditions. Now, most of these companies also offer dividend reinvestment plans, also known as DRIPs, which allow dividends to be reinvested into more shares automatically. It's an easy way to increase income over time without needing to add more capital. With every reinvestment, the future payouts grow a little more. Now the final stretch of the year, March, June, September, and December, completing the 12-stock dividend system. These last 4 companies round out the rotation, filling in the remaining weeks and locking in a full year of consistent income. We kick things off in week 1 with Direction Daily MSCI Emerging Markets ex-China Bull 2x Shares ETF, ticker XXCH. Yeah, it's a bit of a mouthful, but what you need to know is that it brings an 11.09% yield and a surprising amount of consistency for something that sounds a bit exotic. It picks up the income rhythm right where the previous month leaves off and keeps the weekly cash flow rolling without a hitch. Then in week 2, we've got Sonic Shares Global Shipping ETF with the ticker symbol BOAT, BOAT. And this one, it brings in a hefty 13.27% yield, one of the highest in the entire system. BOAT is all about marine transport and global trade. It keeps the momentum high mid-month, providing strong income and adding further exposure to the logistics sector. Week 3 is where International Seaways with the ticker symbol INSW comes in. This company focuses on transporting crude oil and refined petroleum products. Its yield, 7.85%. But the real story here is the reliability. Energy transport may not make headlines every day, but the demand doesn't stop, and neither do INSW's payouts. It plugs perfectly into the 3rd week of each of these months, keeping your momentum strong right through the middle. Finally, Scion Investment Corporation, with the ticker symbol CION, rounds things out in week 4, paying a hefty 14.26% yield. As a business development company, it lends capital to mid-sized firms, earning strong returns and passing them on to shareholders. Scion consistently lands among the highest yielders in this system and serves as a strong close to the monthly income cycle. XXCH and BOAT handle the front end of the month, keeping the early momentum alive, while INSW and Scion finish strong with heavy-hitting yields and industry diversification. Together, they bring exposure to shipping, energy, and mid-market finance sectors with strong, proven dividend histories. Now that we've got all 12 stocks locked in and flowing across the calendar, the big picture comes into focus. Each of the 12 stocks is selected not only for its dividend strength, but also for when it pays. That timing is what turns a handful of quarterly payers into a weekly income machine. So let's break it down and take a closer look at how those dividends land week by week across the entire year. All in all, which stocks will pay you in which month? For this portfolio, it should actually look something like this. Since we know what each stock pays in dividends, it should look something like this. And now that your dividend calendar is complete, it's time to talk about making it real. How do you actually put this strategy into motion? The first step is deciding how much you want to invest. If you're aiming for the full 12-stock setup, a solid starting point is $120,000, split evenly. That's $10,000 into each stock. This approach helps keep your portfolio balanced and make sure no single company holds too much power over your weekly cash flow. But you don't need that much to get started. Even with just a few $1,000s, you can begin building your income machine. Start with a handful of stocks, focus on one payout group, and scale from there. And you can reach the same goal in 3 to 5 years. The system is flexible. What matters most is just getting started. To keep things simple, for our example, I'm taking the $10,000 in each stock approach. One important detail to watch for: the ex-dividend date. This is the cutoff for receiving the next payout. If you own the stock before this date, you're in. If you buy after, you'll have to wait until the next round. So keep an eye on those dates. Keeping a simple calendar or reminder system can help you stay on track. Also, if you really want to watch your income grow over time, think about reinvesting those dividends. Many of those companies offer DRIPs, or dividend reinvestment plans, which automatically use your payouts to buy more shares, which in turn pay higher dividends. This strategy doesn't ask much from you after setup. There's no need to stare at the charts, chase news headlines, or time the market. Once it's built, it just runs while you go about your life. Now, the big question that everyone's thinking: what kind of money can you actually expect to make from this? What are the real numbers behind the weekly income? Let's run through it. If the plan's been followed, around $120,000 split evenly across the 12 dividend stocks, that's $10,000 per company. No day trading, no chasing headlines, just a steady, well-timed system built for income. Here's how it plays out. In week 1, you're looking at an income stream of about $277 to $329, depending on the month. Some months hit harder than others, but the floor stays solid. For example, you'll collect $329 in January, April, July, and October. In March, June, September, and December, it's around $277, and for the rest, February, May, August, and November, it holds at $327. Week 2 follows up with similar consistency, ranging from $321 to $373. It peaks in months like January, April, July, and October, where you'll see $373. The other months stay close behind, with regular payouts of $321 to $332, which keeps your momentum going strong. Then we move into week 3, where returns stay healthy, averaging $196 to $432 per week. January, April, July, and October all clock in at $432. In February, May, August, and November, the weekly payout holds at $300. For the lighter months, March, June, September, and December, it comes in at $196, which still adds up to a meaningful contribution. Finally, week 4 rolls things out with a range of $245 to $387. That top number, $387, hits in January, April, July, and October, thanks to some of the highest yielding stocks in the lineup. In the mid-market months, March, June, September, December, it's $357, and in the softer months like February, May, August, and November, the week closes out at $245. What makes this even more powerful is how easy it scales. Reinvest those dividends automatically or add to the portfolio when possible, and that income starts to grow. Slowly at first, but over time, it compounds. So what does that all add up to? Over a full year, you're seeing weekly income between $1,162 and $1,521 per month, depending on the cycle. That breaks down to a weekly paycheck of around $290 to $380 showing up in your account like clockwork. If you're wondering about annual cash flow, here's what that should look like. It provides a clear breakdown of your monthly returns, showing how your investment generates a steady and predictable flow of income throughout the year. That wraps up this round of dividend strategies, from beginner tips to weekly income setups and million-dollar breakdowns. Hopefully now you've got a clearer picture of what's possible, whether you're just starting out or already building your portfolio.